This portion of Money Matters Boston is brought to you by Flagship Wealth Management.
Welcome back to Money Matters Boston. I'm pleased to introduce Jim Swanson, Mass Financial Services Chief Investment Strategist. Hey, Jim, welcome aboard.
Thanks for having me.
Jim, obviously, Barron's loves what they have to see with Mass Financial Services, always highly rated. Why don't you tell me what differentiates MFS from some of the other competitors out there?
Sure. Well, historically, we're based in Boston, the oldest mutual fund company in the world. So we've been doing this a long time, and we've been through recessions and boom markets and down markets. But mainly, we're bottoms up, and we have a lot of risk controls. And we offer fixed income, international, global research, stocks and bonds, mixtures of both. So over the long run, people have been very satisfied.
You mentioned long run. I think I told you before the show that it was the first fund that I had purchased, the Mass
That's
Investors
right.
Trust, right? And actually, the oldest mutual fund in existence, 1924, right?
Right.
So obviously, you're showing good longevity and everything else. We started off the show talking at one of our trending topics where, Main Street is avoiding the stock side of the market and they're really jumping into the bond side of the market. Can you address that a little bit?
Sure. You can't blame people. They went through a big downturn in 2008, 2009, and you've had spectacular things in the headlines about flash crashes. But the other thing is U.S. corporations are making a lot of money right now, even though the headlines are not great, and the market is up 13% year to date. So I wonder if people aren't on the margin making a mistake by piling into bonds and getting out of equities. Often that happens at the wrong time.
Well, the Fed is out there right now promising rates low through, 2014?
Right.
We get this question asked a lot of us. How does the Fed do it? How can they promise something? And I ask you, can they truly keep interest rates low?
I think they can. They have the biggest balance sheet in the world, and it's infinitely expandable. They don't have any limits on what they do. And so they can go out, and traditionally they've only managed the reserve rate, or the rate that banks charge each other. But recently they've been doing what they call quantitative easing, which is buying in longer-term bonds and using their balance sheet to buy in a whole array of securities and suppress bond yields. I don't think they can do it forever. They don't think that kind of firepower, but for a year or two, I think they could manage it, and they're very keen on doing this. So
well,
I
this
think
QE3, I think it's this QE3 that everybody's hearing about. They're hoping, I saw, Senator Schumer came out and say, please do something,
right.
Chairman Bernanke. Do you think that he's going to answer that call? Do you think that they're going to give out a QE3?
I think it's coming, and the reason I think it's coming is Ben Bernanke, the head of the Fed, is very keen on his job description, which is price stability, no inflation is one way to think about that. The other part of his job description is job growth in the U.S. economy. And with 8.3 unemployment rate, he probably feels he's failing. And he said publicly he doesn't feel he's doing his job until he gets that unemployment rate down. So he wants to lower interest rates in mortgages. That keeps the housing market at least alive. And he wants to lower long-term interest rates so that corporations can borrow and expand. So I think you're going to see more of this, and I think he's keen on using the Fed's balance sheet, which we call quantitative easing.
Sure.
Again, may not be right away, but I think he will.
What else can they do? I mean, you've got interest rates at historic lows. I mean, those that can, and they've already refied, is they're just going to refi again. I mean, what else do you think that the Fed can do? It's that term, pushing on a string.
Exactly.
Is there anything else that they can do?
They're running out of firepower, exactly. When you have rates at 4 or 5% and you can keep lowering rates down as you move down and help the economy that way, you've got a lot of firepower or gunpowder left. You don't have that now. Right now, you're basically at zero interest rates. Long-term rates are also very low. There isn't a lot more they can do, but on the margin, they want to help, and they want to help offset some of the cost cutting that's going on in the states and at the federal government. But will they be able to revive the economy and make it grow at 4% like we did? I don't see that, no.
What can they do? Going back to that hearing in the Senate, they talked about the fiscal cliff, and we talk about it each and every week on this show, that it's happening. What do you think the chances are that that gets resolved between now and January 1st?
Boy, it's a tough one. I think they will. I think everyone in Congress knows the risks, and basically it boils down to this. If you add up all the elements of the fiscal cliff, which is tax increases, tax expirations, you've got payroll tax, healthcare tax in there, and you've got what's called sequestration, which is cuts in federal spending. Add it all together.
Which is what they did last year at this time, right?
Right.
The Gang of Six got together and did nothing. Correct.
Right.
So these are automatic cuts.
Automatic cuts. And that adds up to a real hit to the economy, which could tip the U.S. economy into recession. And I think both sides of the aisle know you don't want to be on the record as having caused a recession. So I think at the last minute, the way the Congress works is they pull out some compromise. Yeah. They'll raise taxes probably on the rich, but not on the middle class. They'll make some cuts somewhere else, but they won't let these taxes go up to the degree that
Boy, I hope you're right. I've seen some economists think that the market could correct 10 to 20% if this doesn't get resolved.
If they do nothing, I think that is a risk. I think that is your downside. And people have to be aware of that. I personally don't think the Congress would let it happen.
You know what, I have, clients are always asking, hey Dave, why should I have money invested internationally? How would you answer that question?
Well, I think everyone should think about having money invested internationally. The U.S. as a percent of the whole world continues to shrink, the world economy, the world markets, and all these other countries are doing very interesting things. So you want some exposure there. These countries don't all move in tandem one way or the other. So it gives you diversification benefits. And there's a lot of growth outside the U.S. that's happening. Our population is growing, but not as fast as some of these other countries like Brazil or maybe China. So I think you want to have a basket of international securities, but you also want someone to watch over them. You don't want to buy a blind pool. Well,
there's 4 months left for the remainder of the year. Now, we thought the market would be up mid to high single digits. As you said, we've already passed it. Are there certain sectors of the market that you'd advise our viewers to maybe start looking at or putting money now versus waiting until the end of the year?
Well, I wouldn't necessarily jump in on any one particular sector, but I think your investors at least ought to take a look at the technology sector. We've talked about some of these, overpriced, famous IPOs and social networking companies.
Sure.
But you look underneath that the companies that trade publicly in the market that service these famous companies, and they're trading at lower multiples than the market, and they're making huge amounts of profit. They don't have debt on their balance sheets. They're exposed to international sales.
And they're sitting on record levels.
And they're having amazing amounts of cash. Exactly. Yeah. And they're changing the way we live. So I would not ignore that sector, and at least I would keep that in my mind. Is something's changing out there. And by the way, the technology sector, from a historic point of view, isn't overvalued, and yet it's now the biggest sector of the whole market. It used to be banks, now it's technology.
All right, I'm telling you, we're being taped right now. We know where the market is today. Does the market finish higher or lower by the end of the year? You're on the spot. You're in the hot seat.
I'm in the hot seat. I think because earnings are so strong, and I think the market eventually follows earnings, that it's going to keep following earnings. And what we watch is labor costs. Labor costs are pretty suppressed in the United States. And that gives these companies a huge advantage. And right now, profits are looking pretty good again for Q3 and Q4. And so I wouldn't be surprised if you see a little more life in the market between now and year end.
Okay, we'd love to have you come back on the show. Maybe towards the end of the year, we'll review this and see where we stuck
That'd be great.
With our predictions. Hey, Jim Swanson, thanks for coming on board. Stay tuned. There's more Money Matters coming your way.